Guys, the stock market is breaking records every single day, every single week, every single month. Everyone's excited, and I understand it completely. You see your account balance go up, you feel warm and fuzzy inside. But if you're a long-term investor, you've got to hear this. Just because the market is hitting all-time highs does not mean your portfolio is safer. In fact, if you don't understand what you're paying and what you're actually getting, you might be setting yourself up for some serious regrets. Let me explain further. Now, guys, I've been preaching for a long time that stocks are overvalued, and I get it. It sounds like a broken record. Too bad. Because stocks are overvalued by every reliable metric, and every great investor in history says that stocks are overvalued currently. Before Munger's death, a year and 9 months ago, he said this was the hardest market he's ever been involved with. So if you've been watching the headlines lately, the market is doing what everyone loves, though. It keeps going up. So it makes guys like me look like an idiot. I get that. But you got to remember, in the short run, stocks are a voting machine. In the long run, they're a weighing machine. All-time highs, record gains, big moves from big names. AR stocks are absolutely crushing it. People are making TikToks about how easy it is to get rich. And those people are very, very, very young. And on the surface, it all looks and feels wonderful. But as someone who has spent decades studying valuations and building wealth by buying great businesses at great prices, I want to be very, very clear. Just because prices are high does not mean that the value is high. Price is what you pay, value is what you get. And this disconnect and not understanding is where people get into trouble. Most people invest emotionally. This is a great story. This is awesome. This is changing the world. I gotta buy it. Then they hear someone else is making a ton of money off Palantir and Nvidia, and suddenly they want in without looking at the numbers. But in this video, I need to give you a better way to invest. We're going to walk through why the market is breaking records right now, the real risks hiding beneath the surface, how to safely invest in this market, and how to find individual stocks that are undervalued, even when the market overall is overvalued. This is not a panic video. This is not to sit there and put fear, uncertainty, and doubt into your mind. This is a video about discipline, data, and education. It's about helping you become a better investor, especially if you're just starting out. This is the Buffett indicator. It compares the total value of our publicly traded US stocks to our country's GDP, which is our economic output. And guys, it makes sense. The bigger and bigger our GDP gets, the bigger and bigger the companies within that GDP should get along with it. So I created my own version based on the S&P 500. Because at the end of the day, the largest 500 companies will also be driven by the price and size of the US economy. And right now, guys, we are 120% overvalued. Not 120% ratio, 120% overvalued based on history. Guys, the ratio is at 2.17 right now. Now, here's what's interesting. Look at this. These are the average returns, 6.4% per year, not including dividends. And here's what we look at whenever we're undervalued going to more overvalued. You see anything crazy? Undervalued by 30% or more, 10.7% returns. About even, 9%. A little overvalued, 2.1%. And as you get more overvalued, the returns get worse and worse. 50% overvalued is negative 2.3% per year for the next 10 years. Guys, we're 120% overvalued as of this morning. Now, I know there's a lot of criticism about this metric. Paul, companies make money overseas and it doesn't count in GDP, blah, 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 blah. It's a negligible amount. But for those of you who care about that, you should obviously care about the 10-year cyclically adjusted PE ratio. It takes the earnings of the S&P for the last 10 years, no matter where they're earned, brings it to today's dollars and gives a PE. We're currently at 39.56. Historical average is 17.74. Guys, at the dot-com peak, we were at 44. So this metric is not as bad as the dot-com peak, but the stock market GDP were worse than the dot-com peak. Guys, it is not going to be good going forward. It is going to be very, very difficult to make money going forward if you invest in the stock market in general. That doesn't mean you shouldn't. What it means is you need to be even more disciplined about dollar cost averaging. And the reason being is if the market is flat for the next 10 years, it won't look like that. It'll look like this. So as long as you buy all along the way, you are going to match the market. And when you're buying right here, you're going to be loaded up because at some point when valuations do take off, you're going to have bought all the way along and you would have made a killing. And guys, guess what? It's going to be tough. There are going to be things that happen in the next 10 years that make you think the stock market's going to zero. You've got to keep on investing. You know why? Because the stock market does go to zero. You may as well invest because your money's not going to be worth anything anyhow. And guys, this doesn't mean that a crash is coming tomorrow. And it doesn't mean I know when a crash is going to happen. It never does. And anyone who says otherwise is a liar. But it does mean that stocks in general are very expensive. And as a value investor, that tells me two things. Be careful, get selective. Part of being careful is dollar cost averaging. I dollar cost average every month into low cost ETFs. And I'm selective when I buy companies that I want at prices that I want them at. So it brings us to the next question. Why is the market up so much? Well, let's break this thing down with the ingredients that are fueling this rally. First off, AI. Everyone's banking on AI transforming industries. And guess what? It will. I believe in the power of AI just like I believed in the internet back in 2000. But a lot of that excitement is probably overpriced in as we speak. Guys, I have loved giving this analogy because we always talk about in the short run, stocks are a voting machine, in the long run, they're a weighing machine. This is Cisco. This was the company in 2000. This was the NVIDIA of 2000. The stock hit an all-time high of $82 a share back here. It has not seen that number since. Now you might sit there and say, did the company do crappy? Guys, from here to here, the profit's up 10x. So if you take out this part, look at this chart. It looks like a great performing, steady business. And that's what I want everybody to understand. The business fundamentally did not get much better here. It just had the short-term voting machine of everybody wanting the stock and watching it collapse. That's important. Now, the comment might be, well, Paul, we don't know the future like you always say. What if the future's better? And that's what happens with companies like NVIDIA. If you were to value NVIDIA at this point right here, it probably didn't make much sense because we didn't know the future. The fundamentals did get a lot better. Enough to justify this price? That's for another video. But the point is, you can't value something without knowing its future. And that's why we require a margin of safety. That's why many true value investors would not have seen this jump. Somebody might have had NVIDIA and looked right. But I have a hard time believing that in 2022 or 2020, somebody said NVIDIA's profit and revenue is going to go up 10, 20x in the next 3 years. The fundamentals got a ton better in this time. The question we need to ask ourselves is this a steady increase or is it going to plateau and go down? Like I said, with Cisco, they didn't have some monster 20x in revenue growth in a matter of a few years. But if you look back at Cisco over its history, this point to this point is 10x in price, and this point to this point is about 10x in profit. It's not a coincidence, guys. In the long run, the stock market is a weighing machine, and anything can happen in between. Up, down, up, down, up, down, up, down. Up, down, up, down, up, down, up. All the while, you've got to be able to emotionally sit there and see this and say, I'm in this for the long haul. That's what makes investing difficult. That's what seeing these all-time highs every single week, every single month feel tough. And it feels different. I don't blame people for thinking that. It feels different to me. Another reason, people think the Fed's going to cut rates soon, which would make borrowing a lot cheaper. Even with rates higher than a couple years ago, money is still relatively cheap historically. You've got to remember, though, that people think that cutting rates is a good thing. I have to remind people, when you cut rates, it's because you think there's an economic slowdown. And when your stock market values are based on such an explosive economy with a lot of potential, there's a disconnect there. Guys, a lot of companies are beating earnings, but you have to remember that both companies and analysts continue to forecast down. That's a very important thing that people have to remember. The number you see the day they report has been adjusted several times along the way. Another thing, and probably the biggest detriment to all this is people hate missing out. FOMO is real, fear of missing out. They see their friends making money easily. They see everybody bragging about all the money they're making, and they get anxious going, I want to make that money. But a real investor understands that a great story at the wrong price can become a bad investment. If you don't understand the numbers behind what you're buying, it could make things very difficult. I'm not telling you to ignore the story. The story is very important. But if you don't factor in the numbers, what you're essentially saying is there's no price that's too high. And this is what makes the market look strong. And a big factor here is people keep investing in low-cost ETFs. The very thing that I'm suggesting you do is the thing that's driving this market higher. Because when people put money in these low-cost ETFs, the ETF companies are required to go buy those stocks, keep on driving them further. But that has led to valuations becoming very, very stretched. Lots of stocks are trading at very high PE, price to earnings ratios, even when their cash flow and balance sheets aren't as impressive. A lot of companies are priced for perfection, and that's a dangerous place to be. It feels like it's going to hit those metrics, but guess what happens? If they miss on those expectations, prices collapse. We're all seeing signs of recession risk and overconfidence, but we never want to believe it's attached to us. Trust me, same thing happens to me. And guess what? When there's overconfidence in markets, that's when bubbles are forming. And every bubble is based on a very logical premise. Stocks are a great place to build wealth. You should dollar cost average. These are things that I'm preaching every single day. Real estate's a great place to build wealth. We had a real estate bubble, then a crash, and I loaded up. Same thing in every stock market crash. So guys, if you're someone who prefers just to stick with index fund or ETFs, the good news is you will do very well sticking to that exact plan. You don't have to guess about if markets are overvalued, undervalued. All you need to worry about is, are you putting money in the market at every single point? Because eventually in the future, you will do quite well. I talk about this all the time about QQQ. March of 2000 was an all-time high. If you bought starting March 10th of 2000 and dollar cost average all the way, you would have seen an 80% drop. And guess what, guys? To this day, you would have made 14 to 15% return on your money by dollar cost averaging after seeing your money fall 80%. And that was assuming you bought you started buying at the very peak. If you started buying here, you're at the 17 to 18% mark. If I told you back then you're going to make 14 or 15% and you saw your stocks fall 80%, you would have called me a liar, because we all react to what's going on more recently. Look at the news now. Everything's great. A lot of things are great. Yeah, there are people talking about overvaluation, and that's likely to happen in such a easy access media world. But if markets were to fall 10% suddenly in 1 month or a few weeks, this narrative would shift. That's why dollar cost averaging works. It allows you to remove the emotion. Just keep doing it like clockwork, and you're going to wake up decades from now very, very wealthy. I assure you. But if you're thinking about investing in the market right now and adding to it or buying individual stocks, just be careful. In fact, I have a method where I say, listen, if you have extra money to invest more when markets are undervalued. Guys, I just made a video that came out. And if you haven't seen it yet, click this card to watch it. It's a video where I talk about how you can outperform the market by doing just what I said. Buying a normal amount when overvalued and adding more to it as it goes undervalued. Now, back to individual stock picking. You don't just want to buy great companies. You want to buy great companies at a great price. Price versus value. Great companies should be valued more, but it still means you can buy them for less than what they're valued at. And it happens all the time. Is it harder? Yes, but that's how you build wealth, picking individual stocks. Don't buy the hype. Don't try to time the market on when things are going to go up or down. But if you pay a great price for a business that creates real value, you can do very, very well. Now, the most common question asked is, how do you know what a company is worth? Well, here's a great question. And here's the answer. A company is worth the money it'll make you in the future in cash flow, in dividends. But it's going to be returned based on the price you pay today. If something was going to make you $1 a year for the rest of your life and you paid $1 million for it, you're not going to do very well. But if you paid $1 for it, you're going to do very, very well because you get your money back in 1 year. The same future stream of cash flows, different price. You've got to look at the same way with a business. How much is the money bringing in? How much cash does it keep? How profitable is it? What's the future look like? Now remember, the future is unknown and we're humans and we make mistakes. That's why I encourage people to be very, very smart about how they make assumptions of the future. Don't make it based on the rosiest of assumptions. In fact, in our stock analyzer tool, let's pull up a company like Adobe. This is why I have low, middle, and high assumptions. And this is why I allow you to go between 1 and 20 years of analysis. We're not going to know the exact performance of a company, but we can make a range of estimates. So when a stock is screaming green on everything, you know you're onto something. Does that mean you go buy it? Not necessarily. It depends on your conviction level. You have conversations with like-minded investors. What am I missing? Go look out there. What am I missing? I just did a video on Tesla, and I went and looked at the most bullish stories about Tesla to say, what am I missing here? But like I told you, this desired return, that's your margin of safety. You got to sit there and put a higher desired return to get a lower price. The less you know about a company, the higher desired return should be. And if price is less than value, you may have found yourself a deal. If price is higher than value, wait a little bit. It's just like you go to a store, you see a $100 jacket that you love. Would you walk up the counter and say, you know what? I want to pay more for this. Or do you sit there and clear it out when it's for sale for $60? Same jacket, different price. That's what we want with stocks. And unfortunately, with a lot of stocks right now, I feel like people are going to the counter and saying, I want to pay more for this than it's worth. Guess what? The best part about this is you don't need to be perfect. You just need to be principled. At Everything Money, this is exactly why it was created. We follow a set of principles, and here are the tenets that I live by. First tenet, we're investors, not speculators. Second tenet, every investment is the present value of all its future cash flows. Third, if we don't understand it, we don't buy it. Fourth, in the short run, stocks are a voting machine. In the long run, they're a weighing machine. And the fifth and most important one, a great story can become a bad investment if you pay the wrong price. Now, guys, I just read off those 5. There's far more to it than just those 5. So if you want to get our free PDF or explains them in more detail, click the link below. Within a minute, that PDF will be emailed to you. You'll have it forever, absolutely free. I strongly encourage you that either if you're an active investor or want to be one, that these are tenets that you understand and you'll probably add to them. And that's important. Now, guys, let me leave you with this. Record highs are exciting. It's awesome to see your account go up, but they require extra discipline. Because when prices outpace value, it's easy to get caught up in the hype and think it's different this time. But that doesn't have to be you. You can stay invested. You can build wealth. You can do it without overpaying or gambling on what everyone else is chasing. That's exactly what principle-driven investing gives you. It gives you a way to grow your money with confidence, clarity, and calm. Guys, the more and more I learn about investing, the more I realize it's successfully done right here. The numbers, they're great. But if you cannot be calm when the numbers scream by because you're worried about the recent stock price, it's going to be difficult to outperform the market. So if you want to see how I apply all of this in real time, I actually did a great video this year where I made my own Magnificent 7 to compete against the real Magnificent 7. I did this back in January because I felt confident that my 7 boring stocks that I owned could outperform the overhyped Magnificent 7. And guess what? In this video you're about to see, they're winning and they're outperforming the market's biggest names. So click the video on your screen to see which 7 stocks they are. Thank you for your time.